I want to ask you why we have US futures up when we haven't had an intervention from Jay Powell walking back his hawkishness on the labour market after that surprise on the payrolls data. Are you surprised by this?
No. I think the context for today's price action needs to be seen in context of what we saw Friday. So the moves in Friday were really extraordinary across assets. Two-year yields erased the entire July move. We saw a climb of 24 basis points in two-year yields in July, and yet we erased all that and more in one session on Friday. I think similarly the dollar index fell really, really harshly, and obviously what we saw both Thursday and Friday in the price action in stocks. I mean, Thursday was probably the more interesting one because we were higher in the morning on positive earnings, and by the end of the day that was all kind of gone and subsided, and then we sank again Friday. So I think that, today we're seeing some positive price action, some good resilience. But I wouldn't misinterpret that. I think that shows that we're kind of in August markets. People can't chase these moves after being so violent on Friday. But I think the moves that we saw on Friday will be the August theme. I think there's some game-changing moments at the end of last week, several of them, and I think that Friday will see a resumption of the kind of Sell America theme. Important to remember that Sell America is not the same as the end of US exceptionalism, two different themes, different time frames, but Sell America will resume in August.
Well, we were so busy with the payroll data on Friday, I think the market kind of missed the ISM manufacturing print, which saw a drop in the headline reading, but also new orders fell and employment fell. Do you think it was something that was maybe overlooked by the market?
Yeah, completely. I think the data on Friday was horrendous. And, there's a lot of excitement on the jobs data, but as many people pointed out, that maybe wasn't quite as weak as the headline numbers imply. And, these revisions have been a recurring theme of the last few years. But generally in the last few years, we've seen jobs numbers print in line with expectations and some horrible revisions lower. And there's still some kind of uncertainty exactly where these numbers will kind of settle up. And the fact is we're seeing a decline in supply in the labour market. So the labour market's, there's not exactly, too much excess unemployment at the moment. So I think the jobs market's not terrible as maybe people hyped it up. But the ISM data really was poor. And the subcomponents there were much worse than people anticipated. So I think we got a set of terrible data, which was compounded by the fact that Trump then moved to remove the BLS chief, therefore undermining the whole principle of the data around the US, which is really, really damaging.
At what point does weak economic data become a positive for the stock market on the assumption that rate cuts then get confirmed?
Not anytime soon. We've generally been in a good data is good news environment for stocks at the moment. Our colleague Tatiana Dowry has built a kind of model of kind of breaking those regimes, and that's the regime we've been in recently. But I also think that this is a market which has priced in rate cuts that haven't been warranted economically anyway because of the pressure on the Fed. It's been really amped up over the past month, but the pressure on the Fed and Powell started back in January and February. And so therefore there's already excess cuts priced into the curve in the US, given that there's no real sign that Fed policy has been restrictive. Look at the stock market at record highs into last week. Look at the data, it has holding up. So I don't think it's going to help anytime soon. I think weak data is bad news for stocks in the short term.